Hey guys, what's up? I'm Erin and welcome back to the channel. One of the biggest components of financial planning comes down to taxes. Consider that over the course of an entire lifetime, according to the Bureau of Labor Statistics, the typical American will pay over $500,000 in taxes. And that's about a third of the entire lifetime earnings for a typical person. So if you can find a way to reduce your tax bill, that means you get to keep more of your hard-earned money. And one of the most prominent times you'll consider taxes is when you start to ask yourself, will I face higher taxes now during my working years or in the future once I step away from the workforce, now or later? And this is really at the heart of the decision when you're looking at a Roth or a traditional account. I did a video on this subject, and safe to say there are some very strong opinions on which account type is the most optimal account type. But amidst all of those comments, there was a genuine question that popped up a couple times, a great question, and it was, can your taxes really be higher in your retirement years? And the answer is yes, they absolutely can be. At first, common sense might suggest that your tax burden look more like a bell curve, going up gradually as your income increases throughout the course of your life, then tapering off slowly as you gradually work less in your later years. Or maybe more like a cliff if you simply go from your peak earning years and straight into retirement. Maybe that's the case, but maybe it's not. You could just as easily find yourself with more income in retirement, and that could push you into a higher tax bracket. Now, as I tend to say, finance is personal, and just because someone could face a higher marginal tax rate in retirement, it doesn't mean that you automatically will face a higher marginal tax rate in retirement. But I thought it was a really wonderful question, and there are a number of factors that can lead to a higher tax burden in your golden years. So I thought we could go over what some of those might be. Let's start with RMDs. RMDs, or a required minimum distribution, is the specific amount of money you must withdraw from a tax-deferred retirement account every year after reaching a certain age. Most often this applies to traditional retirement accounts. Remember, the money for these accounts goes in on a pre-tax basis, where it then gets to grow tax-deferred. But the government gets to a point where they say, hey, we're tired of waiting to tax this money, so you now have to take a withdrawal, that's the required minimum distribution, and pay taxes on that withdrawal. Currently, the government has set this age at 72 or 73, and that's because of new updates through the Secure 2.0 Act that increased that RMD age. You must take your first required minimum distribution for the year in which you reach the age 72, 73 if you reach 72 after December 1st of 2022. However, you can delay taking your first RMD until April 1st of the following year. And as a matter of fact, RMDs are already slated to increase to 75 in the year 2033. Being that RMD age is ticking upwards, that means your money gets to stay invested and undisturbed for longer. That means your money has more time to compound. This could lead to higher account balances, which could also lead to a higher tax burden. So let's look at how RMDs are calculated. The IRS releases a table that allows you to calculate your required minimum distribution based on your life expectancy. Well, let's throw some numbers into the mix. Let's say you were a diligent saver and investor throughout your entire working career, and you end up being one of those 401k millionaires. That is to say that you have a 401k with $1 million in it, and let's say you're 73 years old. Well, according to that IRS table, the distribution period for a 73-year-old is 26.5. So simply you take the balance of your traditional retirement account, in this case $1 million, divide that by 26.5, and that is your required minimum distribution for the year, in this case $38,000. Keep in mind that the distribution actually decreases as you age, and that leads to a larger required minimum distribution. A larger required minimum distribution leads to a higher income, and that can lead to higher taxes. Also keep in mind that a higher income can lead to higher premiums on Medicare Part B and D, as they are income-based. And RMDs are taxed as ordinary income, and it is ordinary income that's often subject to the most aggressive tax rates. Other sources of income, think long-term capital gains, are subject to more favorable tax rates. Widower tax. Now, the widow or the widower tax isn't an official tax, and therefore it's often forgotten about when it comes to retirement planning. But basically, there are tax benefits to being married. Married couples who file jointly qualify for a larger deduction, and the income ranges for tax brackets are met at higher thresholds. In retirement years, if a spouse passes passes away, it doesn't necessarily translate to a significant drop in household income the way it usually does during working years. And many people have their estate set up to transfer entirely to the surviving spouse. And if that happens and there are significant balances in these traditional accounts, or if there's significant sources of income, that can push the surviving spouse into a higher tax bracket, as they're now filing as a single filer as opposed to married filing jointly. Having a well-drafted and appropriate estate plan in place can help to prevent, or at the very least mitigate this. Inheritance. This can be a big X factor, as people are living longer, and this is pushing up the average age of the recipients of inheritances. The average age range for someone to receive an inheritance is now between the age of 41 and 51, but over a quarter of inheritances go to those over the age of 61, many of whom are already retired. Now, many of the items that are being passed on or inherited are actually subject to step-up basis. So when the original owner passes away, the beneficiary inherits that asset at fair market value today. We could use real estate as an example. Say your parents bought a home for $100,000 30 years ago. They pass away and you inherit that home. Today, its fair market value is $500,000. You would inherit this home at its fair market value of $500,000 and not owe taxes on the property. Step-up basis traditionally applies to traditional brokerage accounts, real estate, antiques, collectibles, things like that. It does not apply to retirement accounts. So again, we return to that traditional 401k or the 403b or account type like that. Let's say you inherit an account type like this in your retirement years. This money is taxed as ordinary income. Now, if the account balance isn't all that much, it's probably not a big deal. But if you inherit a very sizable traditional retirement account, that could easily push you into a higher tax bracket. And there are a number of things you can do with an inherited retirement account. You could make a lump sum withdrawal. This would likely pose the greatest tax consequence. You could roll it over into another tax-advantaged account, or you could make your withdrawals over a 10-year period, known as the 10-year rule. Under the 10-year rule, the value of the inherited IRA or 401k needs to be zero by December 31st on the 10th anniversary of the owner's death. If there's any money left in this account after that date, it is subject to an IRS penalty of 50%. So the moral is get it out by that anniversary date. And also, if the original owner of the account had already started taking RMDs, you will have to continue taking RMDs on this account as well. So if you inherit a sizable traditional retirement account, definitely seek the advice of a financial pro. Most often, the Roth variety of these accounts would allow the beneficiaries to take tax-free withdrawals on this money, assuming that this account was established more than 5 years prior to the start of those withdrawals. It's also important to keep in mind that sometimes life has one-time major expenses, and these one-time major expenses can force you to make a significant withdrawal from your retirement accounts. And if these are the traditional variety, that can adjust your tax bracket. Hopefully it's something fun like planning the trip of a lifetime, splurging on a luxury car or a vacation property. Or it could just be something essential like major necessary home repairs. If there are years where you're having to withdraw more than you anticipated, it's important to note that this can have tax consequences depending on the accounts that you're drawing from. It could simply be that you were a diligent saver and built up a portfolio that gives you multiple streams of income, and these multiple streams of income can put you in a higher tax bracket. As a retiree, you're likely collecting Social Security, and up to 85% of Social Security benefits are taxable depending on your circumstances. Then, if you have a pension, consider that pensions are generally funded with pre-tax dollars, so pensions are generally subject to ordinary income tax. Then perhaps you're drawing on brokerage accounts. Maybe you're doing mandatory withdrawals with your RMDs or withdrawing from other brokerage types. Or maybe you have alternative sources of income. Perhaps you have a rental property. All of these things collectively can add up to a significant income stream. And then on top of this, the important thing to remember is that tax brackets, tax rates, tax rules are all subject to change. What the rules look like today could be very different than what they look like, say, in 20 or 30 years' time. And it's not necessarily the easiest to plan around this unknowable. Your marginal tax rate that you face in your working years could very well be higher than the marginal tax rate you face in your retirement years. But the marginal tax rate you face in your retirement years could also be higher than that rate that you faced in your working years. When planning for the future, consider taxes. but also consider your personal circumstance. This demonstrates the importance of having a financial plan that is personally tailored to you. What are your anticipation with taxes going forward? Do you think you're going to pay higher taxes now while you're working or later once you're retired? Let me know in the comments down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye.